Hello, it's Richard Pearce from FinextraTV, and today I'm joined by Sandy Trust. He's head of Organisational Risk at M&G and the recent chair of the Sustainability Board at the Institute and Faculty of Actuaries. Sandy, hello, how are you?
Good morning, Richard. Thank you for having me. Very well, thank you.
Very good. Well, great to see you. Always a great collaborator, and really interested to hear what you've got to say. Now, we've got a paper that we're referring to today. You with the IOFA, which is what I'm going to say instead of that long mouthful going forward,
Yes.
at the Exeter University, recently published a report called "The Emperor's New Climate Scenarios." Now, I read it through. It was pretty damning. Of the accuracy of the NGFS and the UK, the CBES scenarios in predicting the impact of climate change on GDP and the balance sheets of financial institutions. Now, that seems really serious, but for people that don't know, why does it matter what actuaries actually think with regard to climate change and the economy?
Yes, great question. So this came about, Richard. I went with some actuaries to Exeter University to a tipping points conference, and it became very clear at that conference there is a disconnect between science and risk management in financial services. And I became really interested in this, and we agreed the IFOA to work with Tim Lenton, Professor Tim Lenton, who is a very renowned climate scientist, first scientist to publish on tipping points. And what became clear is that risk management in financial services think very differently to science. And I could characterize it like this: if we thought there was an iceberg, scientists wouldn't say there was an iceberg until they had tasted it, licked it, felt it, touched it. They want to be really sure there's an iceberg. And actually, that's the scientific process. It makes sense for scientists to be quite confident before they publish something. Risk thinks completely differently. Risk in financial services is the risk. What could happen if that risk does occur? So risk managers would say there might be an iceberg, or what's the risk of an iceberg? Let's take action. Let's reduce speed. Let's post more lookouts. So a really serious disconnect between risk and science. And what we see is that is reflected in economic analysis of what the impact of climate change might be. Now, you might say, well, look, this is ridiculous. Why are we talking about the economic impact of climate change? Look at the news, look at the fires, look at the floods. But for financial services and financial regulators, economic impact is important. So we set out to answer the question, if you look at financial services climate change scenarios, we set out to answer the question, why are we seeing implausible results here? Why are we seeing published TCFD results, Task Force on Climate Related Financial Disclosures, that say the economic impact of limiting climate change, of transitioning, is broadly equivalent to the economic impact of a hothouse world in which we don't transition? Those results do not make sense. They are implausible. I would say they're incorrect. And so where do actuaries come in? Well, actuaries have well-established principles for looking at results, checking models, validating those results. So we thought it would be a good idea to work with climate scientists and bring those risk management actuarial principles into the realm of climate science to see if we could answer the question, just what is going on here?
Yeah, absolutely. So the limitations of the scenarios that have sort of compelled you to write this, do you want to expand on that for us?
Yes.
And as I say, an actuary, what is an actuary's, if you like, pronouncement? What impact does that have through the financial system?
Well, two quite interesting questions, Richard. Thank you for those. So if we let's look initially at why don't these results makes sense.
Mm.
Why do we get results that say if we get to 3 degrees of warming, we're at 1.2 currently, things are really quite bad. If we get to 3 degrees of warming, we'll have 2% GDP impact. If we get to 6 degrees of warming, we'll have 8% GDP impact. These results don't make sense. So why don't they make sense? To do that, you have to look at the assumptions that are made to reach these results. And one assumption is, what will the damages be? What will the damages be as warming increases? Now, risk management traditionally, actuaries do this. Lots of other risk managers do this. We look at what has happened in the past and make predictions about what could happen in the future. What has the stock market done in the past? So our worst case might be a 40% impact to equities. What's happened to mortality in the past and so on? So economists looked at what happened in the past when it got a bit warmer and people did a bit less work. Okay. And they also made the quite heroic assumption that anybody who worked indoors wouldn't be impacted by climate change. So extrapolating what has happened in the past into the future and ignoring 87% of the economy that works indoors, that's how you get to a 2% GDP impact at 3 degrees of warming. So by definition, extrapolating what has happened in the past excludes future risks which we haven't faced. Climate change is absolutely full of those future risks, in particular tipping points, the physical tipping points. So these are elements in the climate system which might shift from one state to another. I have a water bottle on my desk here. I could nudge it, it might come back to stability, or I could tip it into a different state, and it takes more effort to bring it back. And if the water spills all over the floor, much more effort. So there are bits of the Earth's climate system which can tip. An example would be the Greenland ice cap. As it melts, its altitude decreases, and once it gets below a certain height, it becomes much warmer and goes into kind of irreversible melt. Arctic or boreal sea ice, as the ice melts, you lose the albedo and you get the double whammy of the dark ocean absorbing heat. So the climate system is full of these tipping points which interact with each other, and all of them act either to accelerate climate change by releasing greenhouse gases, or act to accelerate the impacts of climate change. So Greenland ice sheet is a 7-meter sea level rise, right? So if you base your economic impacts of climate change on what has happened in the past, you are by definition excluding all the risks we expect to face.
Right. And so you're eliminating also many other factors, such as, you know, the migration that might happen and all sorts of other things. And so these are the weaknesses
100%.
from within the scenarios. They don't reflect any of this. And so therefore the impact on GDP is, you know, completely erroneous, as you say.
Correct, 100% correct.
So if you're in the financial institution and you're, you know, you've been basing everything on this and all your plans and so forth, you know, and you could rightly say, well, you did it best on the based advice that's been given to you. I mean, what are they supposed to do about it? What are the alternative approaches that can help them manage their risk?
Yeah, great question. I think for me, this is at best. So, well, before I kind of go into that, Richard, I think it's important to say massive progress has been made, and hats off to many scenario providers, many modelers, also many regulators who've really moved from a position in quite a short space of time from not being able to do climate change scenario analysis to having constructed a sausage machine that can spit out results. Now, as we've talked about, those results are implausible. So at best, a very expensive sausage machine, but it doesn't yet have the right ingredients. It's not producing decision useful output. But at worst, I think really dangerous, because you hear the climate scientists, you see Extinction Rebellion, something must be going on, and then you spend X on your modeling, and the answer is it's not that bad. So that could cause people to delay, and it might aggregate up for financial regulators looking at financial stability of the system as a whole to make them think this is not that bad. So what to do about it? I think three things. One, education. It is absolutely critical that executives, decision makers, users, and regulators understand the limitations and assumptions. And that's something as the IFOA, we're very active, particularly engaging with regulators. Two, rich, detailed, qualitative, specific narrative scenarios. So short term, I would say 5-year outlook narrative scenarios that bring together the physical risks and the accelerating pace of climate change, and also the acceleration of the energy transition, because that is also moving more quickly, I think. So now, I think if you create these rich, detailed narrative scenarios, that can let you have, I would say, a much more kind of intelligent, constructive conversation with your business. So
What is
investors,
a narrative scenario? Kind of give us an example of what you mean.
So I think that would be things that combine some of the risks we've talked about. So sea level rise progressing more quickly than expected. So some scientists are predicting low-lying areas inundated by 2050. Storms happening more quickly, heat stress, water is a big one. I think that's particularly relevant for cities. And you can see a number of these factors coming together to impact supply chains for corporates you invest in, to impact certain geographies, certain cities, and things like, what does that do? What does that do to your credit rating for this company or this project? What does that do to your investment thesis for this investment fund?
Right. So where we're doing this sustainable finance live, and we're focused on cities with a lot of these nexus of forces. You're saying that if you looked at that as a rich narrative and you combined all of these variables that you're describing, the financial organization would be looking at, as you say, the sort of the credit risk and the bankability of the solution maybe in a different way. So does that, what happens? I mean, you speak about the insurance industry and so forth. Tell us about how this all ripples through to building that sustainable city if it doesn't appear bankable in these scenarios, in the real world scenarios that you're painting.
It's a fantastic question. As you know, we're already seeing insurance companies pull back from offering insurance in, State Farm in America, for example. And there's a real tension here, I think, between the long-term infrastructure and projects cities need to build, and actually the short-term nature of insurance, which is often priced on an annual basis. Answer from some insurance companies, but not all, is this, we just pull out when the price goes too high. So I think there's a really difficult and important social challenge here between the cities adapting to the future they're going to face, and that's clearly going to be idiosyncratic to each city based on its height, its location, its exposure to floods, its exposure to heat stress, and so on. The role of investors in providing capital for those long-term projects, and the role of insurance in making those long-term projects bankable. What I do, I mean, even if you take mortgages as an example, any homeowner will know that when they take a mortgage out, they have to get insurance. Okay, fine. I don't think maybe any banks check on an ongoing basis that insurance continues to be in place and valid. So, I mean, I, for example, have friends in Edinburgh whose properties are regularly flooded and they never used to be. So I think it's how can I put it? I think this sort of thinking needs to come together for financial institutions. Cities need to be realistic about the risks they're going to face in the future. Investors need to be constructive, and insurance companies need to be in the conversation as well. I think it's a classic case of what Nigel Topping calls radical collaboration.
Right. So I mean, it's sort of insurance and pensions are the money that accumulate over a long period of time from many of us and are used by asset owners to then invest in these projects like cities. So if you're sort of saying, well, the money at one end is not coming in the system, then basically that causes a problem for this whole idea of public-private finance as a way of us financing our way out of the situation. So it sounds pretty bleak. What's the positive? I mean, what do you see as the way out
Yeah,
of it?
I mean, I guess it's with each report. So everything you do, you'll know this better than me. You get one headline. You get one headline. So with this report, the headline was TCFD or financial services models are not capturing climate risk downside adequately. That's the headline, and that's important. A corollary of this is linked to some of the uncertainties of the Earth system modelling, and that's another really important point we hope to write on later this year. But in this paper, and in our previous paper on tipping points, and actually very strongly messaged by Tim Lenton in his foreword, is what we talk about as positive tipping points, positive socioeconomic tipping points. The conference I went to, had the privilege of going to University pre-Christmas, was split 50-50 between negative physical risk tipping points, the Arctic ice cap and so on, and positive socioeconomic tipping points. And this is the hope, and I believe more than just hope, the reality that we can really accelerate the energy transition and get to net zero more quickly than we could have imagined. Now, that's a bold claim. What makes me confident to say that? Well, it's the classic nature of technology disruption. If you look at all technology as disruption, horses to cars, landlines to mobile phones, it follows that classic S-curve of disruption. And we see very, very strong evidence of this in renewables, in batteries, in electric vehicles, where we have both Wright's law, where the cost decreases as volume increases, volume of production increases, and elements of Moore's law as well. And actually, with well-directed policies, we can supercharge the rates of adoption. You've seen offshore wind in Great Britain, electric vehicles in Norway. So there is every hope that intentional, targeted policies that really pick out these positive tipping points can supercharge the energy transition. And cities have such a critical role to play in that when you think about urban infrastructure, energy use, all that kind of stuff. So positive economic tipping points, which we can really accelerate and which are happening anyway. People want this. Increasingly people are seeing and feeling and being scared by the physical impacts of climate change, and that message flows up to politicians so they can put in place those targeted policies. Nature is massive. I know your next hackathon is gonna focus a bit on nature. We have a massive ally in nature, the carbon sequestration ability of the oceans and kelp and seagrass, marine biomass, and not to mention terrestrial carbon sequestration. We have a massive ally that we really need to leverage. So I think there is actually lots of hope. And if you look at policies like the Inflation Reduction Act in the United States, what that has done to accelerate capital flows into low carbon technologies, I think there is real hope here, but no room for complacency. It's really up to all of us. And again, cities have a massive part to play here in accelerating these positive tipping points.
Right, fantastic. So we need a cold hard dose of reality to see the problem. Then we need to put the remedy in, and not just the penalty. I mean, obviously, in Uxbridge, we saw that people didn't like the idea of the penalty, which is about helping them perhaps clean up the air, because you didn't have the IRA type program, which was taking their cars
Yeah,
off the road. So you need the penalty, the remedy, and the hard dose of reality.
yeah,
Yeah.
and I think the hard dose we've been focused on. Simon Sharp read a great book recently, 5 times Faster, on how can we move 5 times faster to decarbonise. And the first piece of that was all about the science. You have to know the risks you're facing in order to take action to avoid it. We're very careful crossing the road because we know if we get run over by a bus, it's not going to end well. Likewise with climate change. If we see very benign GDP impacts from well-respected figures, this includes Nobel Prize-winning economists, that might make us think we can that the hothouse world isn't so bad. So and an analogy would be we're on a raft going down a river. Now, if you think the noise in the distance isn't a waterfall, you might not be very interested in taking evasive action. But I think that's the point we're trying to make. So yeah, I mean, I guess I would completely agree. We have to understand the risks we're facing into, but that should incentivize the action to avoid those risks. And there is every opportunity for the transition to progress much more quickly than it has been.
Fantastic. Well, Sandy, thanks so much for sharing that with us. Really interesting conversation. The paper, we'll post the link to that along with the video, and we hope to talk to you further and examine, the results of it. But for now, Sandy, thank you very much.
Fantastic. Thanks, Richard.